What if you could be wrong on more than half of your trades and still be a consistently profitable trader? It's not a magic trick. It's a core principle of professional trading. The secret isn't winning all the time, but ensuring your wins are bigger than your losses. This is the power of the risk-to-reward ratio. The risk-to-reward ratio is a simple comparison. Your risk is the amount of money you're prepared to lose on a trade, which you define with your stop loss. Your reward is the profit you're aiming for, defined by your take profit. It answers the most important question. Is this potential reward worth the risk I'm taking? Let's use simple numbers. You enter a trade and risk $50 by setting your stop loss. You set your take profit at a level where you would gain $100. Your risk is $50 and your potential reward is $100. This is a 1-to-2 risk-to-reward ratio. Professionals aim for a ratio of at least 1-to-2 on every single trade. Here's why that's so powerful. With a 1-to-2 ratio, just one single winning trade makes back the money from two previous losses. This means you only need to be right 1/3 of the time to break even. If your win rate is anything higher than 33%, you are profitable. This is how traders survive losing streaks. So before you ever enter a trade, do the math. Define your risk with a stop loss, define your reward with a take profit, and make sure the reward is at least twice the risk. By making this a non-negotiable rule in your trading plan, you put the odds of long-term success firmly in your favor.